Almost everyone, including people who eventually build significant wealth, has made several of these mistakes at some point. The goal is to identify them clearly enough that you can recognize them in your own financial life and start correcting course today. Mistake 1. Not tracking where your money actually goes. This is the foundational mistake that makes almost every other mistake on this list possible. If you do not know where your money is going, you cannot fix anything about how it is going there. Most people have a vague sense of their spending. They know roughly what their rent or mortgage costs. They know roughly what their car payment is. But the discretionary spending, the small daily purchases, the subscriptions that quietly renew, the takeout meals that feel insignificant individually, disappears into a fog that most people never actually examine. Here is what happens when you do not track your spending. You feel like you are not spending much, while your bank account tells a completely different story at the end of the month. The gap between what you think you spend and what you actually spend is, for most people, significantly larger than they would guess. The fix is not complicated, but it does require honesty. Track every dollar for 30 days. Use an app, a spreadsheet, or even a notebook. The method matters far less than the consistency. At the end of 30 days, categorize everything and look at the totals with fresh eyes. Most people find at least one category, subscriptions, dining out, impulse purchases, that is dramatically larger than they assumed. You cannot optimize what you do not measure. This is true in business, true in fitness, and absolutely true in personal finance. The first step toward fixing your financial life is seeing it clearly, without judgment, exactly as it actually is. Mistake 2. Lifestyle creep with every raise or bonus. This is one of the most reliable wealth destroyers there is, and it catches high earners just as often as it catches everyone else. Lifestyle creep happens when your spending rises in proportion to your income, so that no matter how much more you earn over time, you never actually get ahead. The raise comes in and the car gets upgraded. The bonus arrives and funds a nicer vacation. The side income starts flowing and gets absorbed into slightly nicer everything. Slightly nicer apartment, slightly nicer wardrobe, slightly nicer everything across the board. Individually, none of these upgrades feel reckless. That is exactly what makes lifestyle creep so dangerous. It does not feel like overspending. It feels like normal, reasonable enjoyment of a growing income. But the cumulative effect is that your wealth-building gap, the space between what you earn and what you spend, never actually widens, no matter how much your income grows. The fix is a simple rule applied with discipline. Every time your income increases, direct at least half of that increase toward savings and investments before you let your lifestyle expand at all. A $1,000 raise means $500 goes straight into your investment account automatically, and only the remaining $500 is available to enhance your lifestyle. This single rule, applied consistently over a career, is the difference between someone who earns a lot and has nothing to show for it, and someone whose net worth grows in step with their income. Mistake 3. Carrying high-interest credit card debt. Few financial mistakes compound as destructively as carrying a balance on a high-interest credit card. The average credit card interest rate sits in the 20 to 25% range, which means a balance that is not paid off in full is actively working against every other financial goal you have. Here is the math that most people never sit down and actually calculate. A $5,000 credit card balance at 22% interest, paying only the minimum payment, can take well over a decade to pay off and end up costing thousands of dollars in interest on top of the original balance. That is money that will never compound for you. It only compounds against you. The psychological trap here is real. Credit cards decouple the pleasure of a purchase from the pain of paying for it. You get the item immediately. The financial consequence arrives weeks later as an abstract number on a statement, disconnected from the moment of spending. This disconnection is precisely why credit card debt accumulates so easily for so many people who would never dream of borrowing the same amount from a friend at 22% interest. The fix requires treating high-interest debt as a genuine emergency, because mathematically it is one. Attack it aggressively, starting with the highest interest balance first. Stop using the cards for new purchases until the balance is cleared. And once it is cleared, adopt a simple, non-negotiable rule going forward. If you cannot pay the balance in full at the end of the month, you cannot afford the purchase. Mistake 4. Having no emergency fund. This mistake turns ordinary, predictable life events into financial catastrophes. A car repair, a medical bill, a period of unexpected unemployment. None of these are exotic surprises. They are normal parts of life that happen to almost everyone eventually. But without an emergency fund, each one becomes a crisis that derails whatever financial progress has been made. Here is the pattern this mistake creates. The unexpected expense hits. With no savings to absorb it, the expense goes on a credit card. Now there is new high-interest debt on top of whatever financial situation already existed. The next paycheck goes partly toward that new debt instead of toward savings or investing. Progress that took months to build gets reversed in a single unplanned event. An emergency fund breaks this cycle entirely. It does not need to be enormous to start. Even $1,000 set aside specifically for emergencies, kept separate from your regular spending account so it is not tempting to dip into, changes the entire dynamic. The car repair becomes an inconvenience instead of a debt-creating crisis. Over time, building that fund to 3 to 6 months of essential expenses creates genuine financial stability that allows every other wealth-building strategy to actually work without being constantly interrupted by life's unavoidable surprises. Mistake 5. Waiting for the perfect time to start investing. This mistake costs people more than almost any other on this list, and it rarely feels like a mistake while it is happening. It feels responsible. It feels cautious. It feels like waiting for better information before committing money to the market. The problem is that the perfect time to start investing never actually arrives. There is always a reason to wait. The market feels too high. The market feels too volatile. There is an election coming up. There is economic uncertainty in the news. Something always feels uncertain, because markets and economies are, by their nature, always somewhat uncertain. Meanwhile, every month spent waiting is a month of lost compounding that can never be recovered. The mathematical reality of compound growth means that the early years of investing matter disproportionately because that money has the most time to grow. A person who starts investing modestly at 25 and stops contributing entirely by 35 will, in many scenarios, end up with more money at retirement than someone who waits until 35 to start and contributes consistently for the next 3 decades, purely because of how many additional years the early money had to compound. The fix is to stop waiting for certainty that will never arrive and start with whatever amount feels manageable right now, even if that amount feels too small to matter. It is not too small. Time matters more than the initial amount. Start today, automate it, and let time do the rest. Mistake 6. Trying to time the market. Closely related to waiting for the perfect entry point is the related mistake of trying to predict short-term market movements, buying low and selling high through active timing rather than staying consistently invested. This mistake is seductive because, in hindsight, market movements always look predictable. It seems obvious, looking backward, exactly when you should have bought and exactly when you should have sold. But that clarity only exists in retrospect. In real time, with real money on the line, predicting short-term market movements consistently and accurately is something that even full-time professional fund managers, with vastly more resources and information than individual investors, fail to do reliably over long periods. The data on this is consistent and sobering. Investors who try to time the market frequently end up missing the market's best days, because those best days often occur during periods of high volatility, right when fear is pushing people to sell or stay out of the market entirely. Missing even a handful of the market's best days over a multi-decade investing period can dramatically reduce total returns compared to simply staying invested throughout. The fix is to abandon market timing as a strategy entirely and replace it with consistent automated investing on a fixed schedule, regardless of what the market is doing. This approach, sometimes called dollar-cost averaging, means you buy more shares when prices are low and fewer when prices are high, smoothing out volatility over time without requiring you to predict anything. Mistake 7. Paying for convenience. You do not actually need. This mistake hides in dozens of small recurring decisions that individually feel insignificant but collectively drain a meaningful amount of money every single month. Subscription services that auto-renew and rarely get used. Food delivery fees that turn a $15 meal into a $30 expense. Premium memberships for services with cheaper or free alternatives that would work just as well. None of these decisions feel like financial mistakes in isolation. Each one is a small, reasonable-seeming choice to trade a little money for a little convenience. The problem is the accumulation. Most people, when they actually audit their recurring subscriptions and convenience spending, are surprised by the total. Streaming services they forgot they had. A gym membership for a gym they have not visited in months. Food delivery apps charging fees and markups on a regular basis. Individually small, collectively often a few $100s a month that could be redirected toward genuine wealth building. The fix is a simple recurring audit. Once a quarter, go through your bank and credit card statements, specifically looking for subscriptions and recurring charges. For each one, ask honestly whether it is providing value proportional to its cost. Cancel what is not. This single habit, repeated consistently, can free up a meaningful amount of money without requiring any dramatic lifestyle sacrifice. Mistake 8. Buying a car you cannot actually afford. Vehicle purchases are one of the most common sources of financial strain, and the mistake usually is not buying a car at all. It is buying significantly more car than the situation actually requires. The financial industry has made it remarkably easy to drive a car that exceeds your actual budget. Extended loan terms of 6 or 7 years make expensive monthly payments feel manageable. Leasing programs make driving a new car every few years feel accessible even when the underlying cost is higher than ownership. Dealerships are skilled at focusing the conversation on monthly payment rather than total cost, which makes an objectively expensive car feel financially reasonable in the moment. Here is the financial reality most people do not calculate clearly. A car is a depreciating asset. It loses value the moment it leaves the lot and continues losing value every year you own it. Every dollar spent on a car beyond what is genuinely needed for reliable transportation is a dollar that will never appreciate, never generate income, and never compound. A car loan at typical interest rates, stretched over 6 or 7 years, often means paying significantly more for the vehicle than its sticker price by the time the loan is paid off. The fix is to separate what you can technically qualify for from what is actually a smart financial decision. A reliable, modest vehicle that meets your genuine transportation needs, financed for a shorter term or purchased outright, frees up monthly cash flow that can be directed toward assets that actually build wealth instead of assets that guarantee a loss. Mistake 9. Buying more house than you can afford. This mistake follows a similar pattern to the car mistake, but with significantly larger stakes, because a mortgage is typically the largest financial commitment most people will ever make. Mortgage lenders will often approve borrowers for significantly more house than is genuinely affordable when all other financial goals and obligations are properly accounted for. The approval amount reflects what a bank is willing to lend, not necessarily what represents sound personal financial planning. Many people treat the approved amount as a target rather than a ceiling and end up house poor, owning a home that consumes such a large percentage of their income that almost nothing remains for saving, investing, or building any other form of wealth. The consequences of this mistake extend well beyond the mortgage payment itself. A larger, more expensive home typically means higher property taxes, higher insurance costs, higher utility bills, and higher maintenance costs. All of these expenses scale with the size and value of the home, compounding the financial strain beyond just the monthly mortgage payment. The fix is to determine your housing budget independently of what a lender is willing to approve, based on a percentage of income that still leaves meaningful room for saving and investing. Commonly recommended at no more than 25 to 30% of take-home pay for total housing costs. Buy within that self-determined budget, even if a lender is willing to approve significantly more. Mistake 10. Co-signing loans without understanding the real risk. This mistake often comes from a genuinely good place, helping a family member or close friend access financing they could not get on their own. But co-signing is frequently misunderstood, and that misunderstanding creates serious financial exposure. When you co-sign a loan, you are not simply vouching for someone's character. You are legally and financially responsible for the entire debt if the primary borrower fails to pay. This is not a remote, theoretical risk. Data on co-signed loans consistently shows that a significant percentage of them eventually require the co-signer to step in and pay, whether due to the primary borrower's financial hardship, a change in circumstances, or simple unwillingness. Beyond the direct financial liability, co-signing also affects your own credit and borrowing capacity. The co-signed debt typically appears on your credit report and counts against your debt-to-income ratio, which can affect your own ability to qualify for loans, even if the primary borrower is making every payment on time. The fix is not to never help family or friends financially. It is to understand precisely what you are agreeing to before you sign anything. If you co-sign, treat it as though you are taking on the full debt yourself, because legally that is exactly what you are doing. If the loan would not be a reasonable financial decision for you to take on directly, think carefully before agreeing to back someone else's version of it. Mistake 11. Ignoring your credit score until you need it. Credit scores quietly affect far more of your financial life than most people realize until the moment they need access to credit and discover the cost of having neglected it. A lower credit score does not just make it harder to get approved for loans. It makes every form of borrowing more expensive, higher interest rates on mortgages, auto loans, and credit cards, which over the life of a loan can add up to tens of thousands of dollars in additional interest, paid for the exact same borrowed amount that someone with excellent credit would pay significantly less for. In many places, credit scores even affect insurance premiums, and in some cases, rental applications and employment screening. The mistake is treating credit as something to think about only when applying for a major loan, rather than as an asset to be actively built and protected over time. By the time someone realizes their credit needs attention, they are often in the middle of trying to get approved for something important, a mortgage, a car loan, and discover the cost of years of neglect at the worst possible moment. The fix is to treat your credit score as an ongoing asset rather than an afterthought. Pay every bill on time without exception, since payment history is the single largest factor in most credit scoring models. Keep credit utilization low. Check your credit report periodically for errors, which are more common than most people assume. Building and protecting good credit before you need it means that when a major financial decision arrives, you are positioned for the best available terms rather than scrambling to repair years of neglect. Mistake 12. Not negotiating salary or major purchases. This mistake costs people enormous amounts of money over a lifetime, and it persists largely because negotiation feels uncomfortable, even though the financial stakes are significant. Research on salary negotiation consistently shows that a large percentage of people never negotiate their starting salary or raises at all, simply accepting whatever is initially offered. The cost of this compounds dramatically over a career. A starting salary that is even a few $1,000s lower than it could have been, left unaddressed, affects every subsequent raise, calculated as a percentage of that lower base, as well as retirement contributions, calculated as a percentage of income. Over a 30 or 40-year career, the cumulative cost of never negotiating a starting salary can run into hundreds of thousands of dollars. The same discomfort that prevents salary negotiation also prevents people from negotiating major purchases, cars, homes, even some service contracts, where the listed price is frequently treated as fixed when it often is not. The fix is to recognize negotiation as a skill that can be learned and practiced rather than a fixed personality trait some people have and others do not. Research market rates before any major negotiation. Practice the specific language you intend to use. Understand that for most major financial decisions, the worst realistic outcome of asking is simply hearing no, while the potential upside, repeated across a career or applied to major purchases, is substantial. Mistake 13. Putting off retirement contributions. This mistake feels reasonable in the moment because retirement feels distant, especially earlier in a career when more immediate financial priorities feel more pressing. But the mathematics of compound growth make this one of the most expensive forms of procrastination available. Every year that retirement contributions are delayed is not simply a year of missed contributions. It is a year of lost compounding on money that would have otherwise been growing for decades. Because compound growth accelerates over time, the contributions made earliest in a career are disproportionately valuable compared to contributions made later, even if the later contributions are larger. Many employers offer some form of matching contribution on retirement accounts, which makes this mistake even more costly when it includes failing to contribute enough to capture the full employer match. Not capturing an available match is functionally turning down free money, guaranteed immediate returns that are extraordinarily difficult to replicate anywhere else in personal finance. The fix is to treat retirement contributions as a non-negotiable line item, automated directly from each paycheck before the money is ever available to be spent elsewhere. At minimum, contribute enough to capture any available employer match in full. As income grows, increase the contribution percentage. The specific amount matters less than starting consistently and as early as possible, because in retirement investing, time is the single most valuable and least recoverable resource available. Mistake 14. Keeping all your savings in a low-interest account. This mistake feels safe, which is exactly why it is so common and so persistent. Money sitting in a basic checking or low-interest savings account feels protected, stable, and accessible. And in terms of nominal dollar amount, it is safe. The number on the statement will not go down. But this safety is an illusion when inflation is factored in. If a savings account is earning minimal interest while inflation runs at a higher rate, the actual purchasing power of that money is shrinking every year, even though the dollar amount displayed is staying the same or growing slightly. Money that feels safe is, in real terms, quietly losing value the entire time it sits there. This mistake often comes from a reasonable instinct, wanting to avoid the risk and volatility associated with investing. But the framing misses an important distinction. There is a difference between money that needs to remain stable and accessible, like an emergency fund, and money that is meant for long-term goals and could be invested for growth instead. Treating all savings the same way, regardless of purpose and time horizon, means long-term money never gets the chance to actually grow. The fix is to separate your money by purpose and time horizon. Keep true emergency funds and near-term needs in accessible, stable accounts. But money intended for goals 5, 10, or more years away, including retirement, belongs in growth-oriented investments, where it has the chance to actually outpace inflation over time, rather than quietly losing value while sitting still. Mistake 15. Making major financial decisions based on emotion. This mistake shows up across nearly every category of financial decision: investing, spending, borrowing. And it is one of the hardest to recognize in the moment, because emotional decisions almost always feel completely rational while they are happening. Fear drives people to sell investments at market bottoms, locking in losses that would likely have recovered had they simply stayed invested. Excitement and social pressure drive people to make large purchases they cannot genuinely afford, justified in the moment by feelings that fade quickly once the purchase is made. Stress and anxiety drive impulsive spending as a coping mechanism, providing temporary relief while making the underlying financial stress worse. The pattern across nearly every example of this mistake is the same. A strong emotion arrives, and a significant financial decision gets made quickly in response to that emotion, without the pause that would allow a more rational evaluation to occur. The fix is building in deliberate friction before major financial decisions, specifically designed to interrupt the emotional impulse. A rule requiring a 24 to 48-hour waiting period before any significant purchase. A rule against checking or adjusting investments during periods of high market volatility when emotion is running highest. A habit of naming the emotion driving a financial impulse before acting on it. None of these eliminate emotion from financial decision-making entirely. That is not realistic. But they create the pause that allows more rational judgment to participate in the decision alongside the emotion. Mistake 16. Comparing your finances to other people's lifestyles. This mistake is amplified enormously by social media, but it predates it significantly. The tendency to measure your own financial progress against the visible lifestyle of people around you, neighbors, co-workers, friends, and increasingly strangers online, drives an enormous amount of unnecessary and counterproductive spending. The fundamental problem with this comparison is that it is based on incomplete and frequently misleading information. The visible markers of someone's lifestyle, the car, the vacation photos, the home, the clothes, reveal almost nothing about their actual financial position. Someone displaying significant visible wealth may be carrying significant debt to maintain that appearance. Someone living more modestly may have a substantial investment portfolio that simply is not visible from the outside. External displays of wealth and actual financial health are frequently unrelated or even inversely related. Comparing your financial life to other people's visible lifestyle creates a treadmill that never ends because there is always someone with something more impressive to compare against, and the comparison provides no useful information about whether your own financial decisions are actually sound. The fix is to deliberately shift the comparison from other people to your own past financial position. Are you further ahead than you were a year ago? 2 years ago? That comparison is both more accurate and more motivating because it measures genuine progress against your own specific goals rather than against an incomplete and often misleading external standard. Mistake 17. Neglecting insurance and calling it saving money. This mistake often masquerades as financial discipline. Skipping insurance coverage or carrying inadequate coverage can feel like a smart way to reduce monthly expenses. In reality, it is frequently a significant unmanaged risk masquerading as a cost-cutting decision. The math on insurance is straightforward when you actually examine it. The cost of appropriate insurance coverage is, in almost every case, dramatically smaller than the cost of the catastrophic event it protects against. Health insurance protects against medical bills that can run into hundreds of thousands of dollars for a serious illness or injury. Disability insurance protects your single largest financial asset, your ability to earn income, against the possibility of being unable to work. Adequate auto and home or renter's insurance protects against liability claims that can threaten years of accumulated savings in a single incident. Skipping or underinsuring against these risks to save a relatively small amount on monthly premiums is a bet that the catastrophic event will not happen. Sometimes that bet pays off, and the money saved feels like a smart decision in hindsight. But when the bet does not pay off, the financial consequences frequently dwarf years of premium savings many times over. The fix is to evaluate insurance not as an optional expense to minimize, but as a strategic component of an overall financial plan. Identify the risks that could genuinely threaten your financial stability and ensure they are adequately covered, even if that means the monthly premium is higher than the absolute cheapest available option. Mistake 18. Never increasing financial education after school. This mistake is rarely discussed as a mistake at all because most formal education systems provide minimal practical financial education in the first place, leaving most people to navigate complex financial decisions with whatever knowledge they happen to absorb informally. The consequence of this gap is that many significant financial decisions, buying a home, choosing investments, understanding debt, planning for retirement, get made with limited genuine understanding of how they actually work. Decisions get based on what feels intuitively right, what a salesperson or advisor recommends without independent verification, or what seems to be the conventional path other people are taking, rather than on genuine financial literacy. Every other mistake on this list becomes significantly less likely when paired with genuine financial education. Understanding compound interest makes mistake 5, waiting to invest, feel obviously costly rather than cautiously reasonable. Understanding the mechanics of credit card interest makes mistake 3, carrying high-interest debt, feel clearly unacceptable rather than a normal part of life. The fix is treating financial education as an ongoing practice rather than something completed once, if at all, during a single class in school. Reading books, listening to audiobooks like this one, following credible financial content, and asking genuine questions when something is not understood rather than nodding along. All of this compounds over time into a level of financial literacy that dramatically improves the quality of every financial decision that follows. Mistake 19. Having no specific financial goals. This mistake creates a kind of financial drift where money gets earned and spent without any clear direction guiding the decisions in between. Without specific goals, there is no real basis for evaluating whether any individual financial decision is moving you forward or simply maintaining the status quo. Vague intentions like wanting to be financially secure or wanting to retire comfortably provide almost no actionable guidance. They do not specify how much money is required, by when, or what behaviors need to change to get there. Without that specificity, it becomes very easy to deprioritize saving and investing in favor of whatever feels most appealing in the moment, because there is no concrete target being measured against. Specific goals function very differently. A goal to accumulate a certain net worth by a certain age or to save a certain amount for a down payment within a certain time frame creates an actual decision-making framework. Every financial choice can be evaluated against the question of whether it moves you closer to or further from that specific measurable target. The fix is converting vague financial intentions into specific written, measurable goals with associated timelines. Not someday I want to retire comfortably, but a specific net worth target by a specific age, broken down into the specific monthly savings and investment amounts required to get there from your current position. This specificity transforms abstract aspiration into an actionable plan that can actually guide daily financial decisions. Mistake 20. Believing it is too late to start. This is the final mistake, and in many ways it is the most consequential because it can prevent every other correction on this list from ever actually happening. Many people, upon recognizing several of the mistakes covered in this audiobook in their own financial history, respond with a sense of resignation rather than motivation. The thinking goes something like this: too much time has already been lost, too many mistakes have already compounded, and meaningful financial improvement at this point is no longer realistically possible. This belief, while understandable, is almost never accurate, and it becomes a self-fulfilling prophecy precisely because it prevents the very actions that would actually improve the situation. Yes, starting earlier is mathematically advantageous, and time lost cannot be fully recovered. But the financial trajectory from today forward is still entirely within your control, regardless of what has happened in the past. Every single mistake covered in this audiobook can begin being corrected starting with your very next financial decision. The fix is recognizing that today is, by definition, the earliest possible day to start making better financial decisions for the rest of your life. The version of you 5 years from now will either be grateful that today became the turning point, or will be having this same internal conversation again, having lost 5 more years to the belief that it was already too late. It is not too late. It is simply time to begin. 20 mistakes, none of them exotic, all of them common, ordinary, and correctable. Let's bring them all back one final time. Mistake 1. Not tracking where your money actually goes. Mistake 2. Lifestyle creep with every raise or bonus. Mistake 3. Carrying high-interest credit card debt. Mistake 4. Having no emergency fund. Mistake 5. Waiting for the perfect time to start investing. Mistake 6. Trying to time the market. Mistake 7. Paying for convenience you do not actually need. Mistake 8. Buying a car you cannot actually afford. Mistake 9. Buying more house than you can afford. Mistake 10. Co-signing loans without understanding the real risk. Mistake 11. Ignoring your credit score until you need it. Mistake 12. Not negotiating salary or major purchases. Mistake 13. Putting off retirement contributions. Mistake 14. Keeping all your savings in a low-interest account. Mistake 15. Making major financial decisions based on emotion. Mistake 16. Comparing your finances to other people's lifestyles. Mistake 17. Neglecting insurance and calling it saving money. Mistake 18. Never increasing financial education after school. Mistake 19. Having no specific financial goals. Mistake 20. Believing it is too late to start. None of these mistakes require a dramatic, all-at-once correction. Pick one, the one that resonated most as you listened. Address it this week, then move to the next one. Wealth is not built by avoiding every mistake perfectly from day one. It is built by recognizing mistakes honestly and correcting course consistently, one decision at a time, starting now. If this audio added value, share it with someone who needs to hear it. Subscribe to Mindset Wealth Blueprint for more content like this every week, and drop a comment telling us which of these 20 mistakes hit closest to home. We read everyone. Thank you for being here. Now go correct course.